restrict, we say to 3 million. So when you buy an asset, and that is the addition, in case of SUV, those are sport utility vehicle, Mercedes-Benz, Land Cruiser, and saloon car. We're basically saying that if the value exceeds 3 million, we restrict to 3 million. We respond with a yes. We restrict to 3 million. Give me a yes if you're together. We basically restrict to 3 million. Perfect. So then the last part is on the disposal part. The last part is for disposal, we say the following qualifies, we say to be what we call the disposal, qualifies to be disposal value. That for disposal, the following qualifies to be disposal value. Number one, that will qualify to be disposal value, we call it sales proceed. We call it sales proceed of an asset. So the value that you get when you sell an asset altogether, the value that you get when you sell an asset, that will qualify as the disposal value. Together, team, that in case of disposal, the sales proceed, the value that the asset has been sold, qualifies to be the disposal value. Together, in case the sales proceed of an item. The number two is for an item stolen, for an item stolen, for an item that is stolen, or we say involved in an accident, for an item that is basically stolen or involved in an accident. We say insurance, we say that insurance compensation, we say qualifies to be what it qualifies to be the disposal value. Make sure those concepts are at the back of your mind. Let's say, for example, you had an asset, and you're saying that, for example, for an asset that is stolen or involved in an accident, the disposal value will be what you call the compensation. The insurance compensation qualifies to be the disposal value. For an asset that is stolen or was involved in an accident, the value that is compensated by the insurance company is what qualifies to be the disposal value. You give me a yes if we are together. That value qualifies to be what we call the disposal value. Perfect. Thank you so much. Then the last item before we get to the question. For saloon cars, then say for saloon cars and what we call the SUVs, for saloon cars and SUV, for saloon cars and SUV, if the value, we say, was restricted, if the value was basically restricted, if the value was restricted, if the value was restricted, when added, let's say, when added, we say disposal value, we say is determined as follows. So if you're disposing an asset that was basically restricted, an asset that was restricted during addition, are we together? So the disposal value should also be restricted. I am saying that if when you're adding an asset, the asset was restricted. It therefore goes that when you're disposing, it therefore goes that when you're disposing, the asset should also be restricted. So how do we get the disposal value in that case? So say that the disposal, we say that the disposal value, i.e., we say disposal value, the disposal value should be, what do you call the sales proceed? Sales proceed, that is just the SP, sales proceed. The disposal value should be the sales proceed over what you call the initial cost. Then you say times restricted value, which is 3 million. Are we together here, team? I want us to understand this. That if basically, we are saying that if basically you are disposing an asset that was restricted when you are adding it together. Therefore, it goes that when you're disposing also that asset, you need to restrict. How do we restrict? We say the sales proceed over what you call the initial cost, that is the buying price, then you multiply by 3 million. This will not qualify as what? As the disposal value, but you restrict. What you get is what you get as the disposal value, Tubonyeza yes, kama tuko sawa. Tubonyeza yes, kama tuko sawa. If you're together, we respond with yes. If we are together, we respond with yes. Perfect. Then I only have to make one statement. In case of trade-in, in case of what we call the trade-in, the disposal value, when you're talking about trade-in, in case of trade-in, the value of the old asset is deducted as the disposal value. You're saying that in case of trade-in, we say that in case of trade-in, lastly, we say in case of what we call of trade-in, the value of what we call of the old, asset, we say qualifies as what we call as the disposal value. The value of the old asset qualifies as what we call the disposal value. So that is that. I want us now to go to the practical work. Is there any question before I get to the practical work? Kuna mtu ana swali? Is there a question? Kuna mtu ana swali? Can I proceed to the questions? Is there any question regarding, we move on, perfect. So I want the first question. I want us to start on the first question. I want us to pick on December 2024. I want us to pick on December 2024. That is question 4C. December 2024. We start with the first question, deck 2024. Question 4C. Deck 2024. Question 4C. Are we on it? Let's start with that question. Deck 2024, question 4C. Deck 2024, question 4C. If you're there, you respond with a yes. Deck 2024. So perfect. So I want us to read that question. So we're being told, Adam Mwema, the examiner tells us that Adam Mwema, a retired engineer.
Okay, so what are we told? What are we told? That is the question number 2. So the question is, 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in 𝐻𝐻𝐻 Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred what? Consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐿 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity, public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐿𝐿, 𝐻𝐻𝐻, and 𝐶𝐶𝑠. We have the statement of financial position for the 3 companies, that is 𝐿𝐿, 𝐻𝐻𝐻, and 𝐶𝐶𝑠. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called 𝐻𝐻𝐻, a public limited company on 1st April 2024. So the company which is called 𝐿𝐿 Limited, this company acquired 80% equity shareholding in a company which is called 𝐻𝐻𝐻 Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿 is the parent and then 𝐻𝐻𝐻 is the subsidiary. You can see also we're given the date of acquisition. Then from there, once we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿 Limited, our parent company, with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶𝑠 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝐶𝑠 Limited. 𝐶𝐶𝑠 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one would be a joint what? A joint venture. So that is the first thing you always need to have because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of CSAS. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalue the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you see in most of the questions for group account, you will come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of